Good morning. Welcome once again to Digital Lug TV. Joining us today is Michael Hewson. He is Senior Market Analyst at CMC Markets UK. Michael, good morning. Thank you for joining us.
Good morning, Alex.
Okay, markets seem like they're quite a bit calmer. The S&P is at record highs. U.S. Treasury yields have come off the boil. Bernanke, he's making soothing sounds, soothing words. Do we believe all of this, or is it a bit of a false dawn?
I think you've got to put it in the context of what Mr. Bernanke said on May the 22nd. Now, he sort of floated the idea that the Fed was looking at tapering their asset purchases program if the economic data continued to improve at its current rate of knots. Now, since then, we've had a fairly good payrolls number, but we've had not particularly great housing data. Now, part of the US recovery has been predicated on a recovery in the housing market. That does appear to be starting to moderate slightly, and I think that's largely down to an increase in mortgage rates in the US. People are much more reluctant to basically put their foot back on the housing ladder because it's becoming more expensive to borrow money. So last week, he said he sort of stepped back a little bit from that and suggested that he didn't want to. He tried to make the distinction between tapering and tightening, and the market was factoring in a rise in interest rates, which essentially was never on the table. But the market heard tapering, pull back, and started to factor in a rise in interest rates, which was never really going to happen. The forward guidance is out to 2016. The Fed are pumping in $85 billion a month. That's not going to slow down anytime soon. And even if it does, the Fed is still expanding its balance sheet to the tune of 85, 75, 65, 45. So it's still remaining accommodative. Now, yesterday, he reinforced that message. And I think the markets are starting to hear it. The Fed is going to remain accommodative. It's going to be data dependent. But having said that, they're not ruling out tapering by the end of the year. I think, based on the current trajectory of the data, that's unlikely. I think at the earliest we may see it in December. You have to remember Bernanke's leaving the Fed in January. So he's got one eye on his legacy, but also one eye on what the US economy is doing. And he made a very, very interesting point yesterday when he said he was worried that the economy could tank if they withdrew stimulus too early. So that does appear to have assuaged the bond markets. The 10-year yield has come down. It's below 2.5%. It did go to 2.75. I think he's done a great job in sort of performing a bit of a high wire act with respect to that. And I think yields should come back down. What does that mean for the S&P? I think it could continue to probably push higher, but we're going to have quite a bit of volatility as US economic data fluctuates over the coming months.
Okay, fantastic. Question, changing asset classes, talking about the currency markets, the euro dollar. So far year to date, it seems like it's in a broad trading range. It's come down towards 127.50, 128, correct me if I'm wrong.
No, that's right.
Okay, but it doesn't seem to break through. It seemed like it was set up for a potential trigger, say strong jobs reports in the coming months. If the data convinced the market sufficiently, we would see a break lower. But if you believe that QE will not be tapered until December, perhaps that is a fake lower, but really the move towards the end of the year might be higher?
Eurodollar is a bit of a strange one. As you rightly said, it's in a range. The base of that range, in my opinion, is 127.50. Now, the reason the euro is so resilient at the moment is because the Fed is still expanding its balance sheet. The ECB isn't. Mario Draghi talked about forward guidance, but the message from Mr. Draghi is confused because he won't give a time frame on it. When he was pressed upon it in the press conference, and he was asked, is it 6 months? Is it 12 months? No, it's an extended period. Well, what's the extended period? When Bernard Kohr was pressed upon it, he said, we'll review it every month. Well, it's not forward guidance if you review it every month. So, what is it? So the ECB is shrinking its balance sheet because the LTROs are being repaid. The Fed is still expanding it. There's therefore no reason to buy dollars and sell euros unless, and I use the word unless, you get a blow up in Southern Europe or somewhere else, which causes sovereign bond yields to push back up towards the danger level 7%.
Okay, interesting. All right, I want to come back to this theme of Europe, but just so we don't leave the States for now. There are people who are pointing out, I've seen some of the most recent estimates from economists. Barclays has US GDP tracking at 0.6% for the second quarter, which is nudged a little bit lower, and you're close to flat.
Yeah, that's obviously quarterly, but I think you've got to factor in sequester cuts, you've got to factor in the fiscal cliff. Retail sales are still growing, the housing market is still pushing upwards. Manufacturing is probably not doing as well as it could be, but the jobs market is still adding jobs at around about 200,000 a month. So growth is still growth. If you annualise that, the forward forecasts are around about 1.82%. Well, if you take out the sequester cuts, that's actually quite healthy, because you take them out, because obviously they're front loaded, and then you project forward.
So the outlook for corporate earnings, you think there is enough staying power in the economy for corporate earnings to recover?
I think there is, but as I said, the US market is still slightly overvalued in terms of other markets, say in Europe. It has made new all-time highs. You certainly can't say that for the FTSE 100. You can for the DAX, but the DAX has fallen back and it's not recovered all of those gains that it saw in May. So I think the reason US equities are as high as they are is obviously as a result of the Fed being very accommodative. But at the end of the day, earnings do have to come into it. And I think that's why the air is a little bit thin, but it doesn't necessarily mean there's not any more upside in it, because relative to bonds, stocks are still a good place to be.
As an aside, you just mentioned the DAX. The S&P is at record highs again.
Yeah.
The DAX is not. Why not?
Well, I think it's largely because of German exports to China. If you look at what's happening in China, there's a slowdown going on there. Also, one of Germany's key export markets is Europe. And, well, we know what's going on there. So I think there is a concern that German company profitability could be impacted by a slowdown in two of their key markets, Europe and China.
I see. Okay. All right, let's change tack and let's talk about what most matters to people here in the UK. Mark Carney, Bank of England, MPC. There really has been a sea change as far as the strategy, the communications. But above all, and most immediately, quantitative easing, additional quantitative easing is off the table, it seems.
For the time being, let's see what happens in August. I think Mark Carney's come in, he wants a clean slate. I've never been convinced for the need for an additional £25 billion worth of QE. Since the beginning of the year, the data's been going in the right direction. Doesn't really need a helping hand. And I'm not totally convinced that the £375 billion of QE has gone where it should have anyway. Now, they've been using other tools, the funding for lending, the help to buy, which I think is a mad scheme, taking on taxpayer liabilities for keeping out the housing market at very unrealistic levels. Average incomes relative to house prices are still way below where they should be. Typically your average income should be 3.5 times. It's well above that. You're pricing out, buyers, young buyers from the housing market. The housing market needs to adjust. You don't need to inflate another bubble.
Right.
And certainly the taxpayer should not be underwriting loans to, young buyers.
However, to an extent, you need that bubble to help prop up another bubble, in a sense, perhaps, which is the state-owned lenders, such as RBS, no?
Well, the state-owned lenders, RBS, Barclays, Lloyds, weren't lending money. They shouldn't need a government guarantee to lend money. And the reason they're not lending money is either because the demand isn't there, or the houses aren't there, or people need to deleverage, the private sector needs to deleverage. Now in the US, the housing market came down. The bad debts were written off. And to a certain extent, that's what needs to happen here. Because if you actually look at the US economy and the private sector and the UK private sector, some deleveraging has happened in the US private sector. That hasn't happened here in the UK. the private sector hasn't deleveraged to the extent that it should have, and it needs to do that. So what Mark Carney needs to do is give confidence that interest rates are going to remain low, so that consumers can deleverage. And until that happens, I think growth will remain fairly tepid. Having said that, we've seen fairly good growth so far in the first half, but it's been driven by the UK consumer, which is 70% of GDP. So you have to ask yourself, is that sustainable? And I would argue that it's not. It's going to come in fits and starts. They need to stimulate demand or expand the size of the manufacturing sector and the construction sector. And I think that's why when the Chancellor talked about infrastructure projects in the budget, he was going in the right direction.
So no more QE probably. Probably will go for infrastructure spending to help stimulate the UK economy.
And some form of forward guidance, some form of guidance to the market that interest rates aren't going to jump sharply anytime soon. But I think also a lot will depend on what the Fed does, because after May the 22nd, it wasn't just US bond yields that jumped. It was also UK, European, and emerging markets. So I think you're going to see an awful lot more collaboration between the Fed, the ECB, the Bank of England, to make sure that rates stay fairly low, or if they do rise, they rise for the right reason, i.e. because the economy is recovering and not because markets are worried that people are going to withdraw stimulus too early.
Okay. Listening to, or rather reading the minutes of the last MPC meeting, there's a lot of reference to forward guidance. And in my head, I'm not sure if that might also happen to a lot of viewers, I wonder if there isn't contamination from the talk that you hear about forward guidance in the US Federal Reserve. In other words, people might hear Carney say one thing and they might think that he is trying to take the same tack as Ben Bernanke, whereas he is actually laying out a rather different strategy, like you said before.
To be fair to Mr. Carney, he actually set the template for forward guidance, not Mr. Bernanke, because he did it in Canada. So Bernanke is really following Mr. Carney, not the other way around. So I would suggest that Mr. Carney's got a fair idea of what he's doing. The key problem that he will have is if he gives forward guidance too far out and the economy starts to recover, he may have to raise interest rates quite sharply, and that could actually shock the economy. So, he's got to play his cards very, very carefully, but he's also got to make sure that he's not politically steered either. He needs to retain the independence of the Bank of England while acknowledging the fact that he is a political appointment, and that's going to be a tough balancing act. Hopefully he can pull it off. Hopefully he's a lucky governor. At the moment he's come at the right time. The UK economy is recovering, albeit patchily. What we need to see in the third quarter is to make sure that recovery is sustainable.
Okay, you made reference a little bit back about a synchronized rise in long-term interest rates globally. There is an old adage or a proverb at the Fed. It's my monetary policy, but it's your problem. We have coming up soon the meeting of the G20, emerging markets. How much of a problem might it be for them, this rise in interest rates globally?
It's definitely been a worry and concern in the context of money being pulled out of emerging markets, but I think that was largely as a result of concerns that the Fed was going to withdraw stimulus too quickly. Given what Bernanke has said, or could say, or reiterate over the next day or so, because he still has to give another day of testimony, I think that's going to be less of a problem, because if you saw the reaction to what he said, bond yields have started to come down. So if he manages to maintain that balancing act, I think that could well correct itself normally.
All right. Talking, it's not really an emerging market, or not quite. Tell me if I'm wrong again. China. A couple weeks ago, everybody was very scared about the slowing in Chinese data. Economists continue to shave their forecasts lower. But yet, last week we had the country's finance minister warning that growth in the country could be lower than the government's own estimates. Is the cat out of the bag or not?
I think the cat was out of the bag a long time ago with respect to China. There's been an awful lot of questions raised about the quality of its data. I've always found it rather strange that a country that can grow at 6% a year basically records PMIs, manufacturing PMIs below 50. When you look at PMIs in Spain, Germany, UK, US that are below 50, you know, and the GDP numbers are either side of zero to or by about 0.5%. So, you know, it depends what you believe the real, the GDP number is in China. Obviously, they've got more scope in terms of boosting domestic consumption. Retail sales are running around about 12 or 13%. So, from that point of view, there's a certain amount of optimism there. But I think it's unrealistic to expect China to pick up the slack for everybody else. There's only so many roads you can build. There's only so many tower blocks you can build. So, you know, I think going forward, I think the new reality is China is not going to be growing at the rate that it has been. Lowest GDP in 23 years. Going to have to get used to that, I'm afraid, and adjust accordingly.
Okay. But there isn't, I guess you could say, an imminent blow-up waiting to occur in China.
No, because I think part of what the Chinese central bank is doing is it's dealing with its own banking problems, and it's keeping policy tight to try and tell its banks, look, no more irresponsible lending, and we're not going to bail you out. You sort out your bad loans, you write them off, we'll do whatever you need to do, and if a bank fails in China, well, I'm not convinced we'd hear about it anyway.
Okay. Let's see. The eurozone. We don't hear too much about it. You do about Portugal, Greece, but I think usually the news flow about these countries is more or less written off because they're relatively small. But in the long term, you have national interests.
I think the problems in Europe, as well as being economic, are more political in nature. I think the game changed a year ago when Mr. Draghi basically said that he would do whatever it takes to save the euro. With the as yet untested OMT program, that the markets haven't wanted to test that. At some point, so what he's basically done is he's taken fragmentation risk off the table for the time being. Now, what people are looking at is debt sustainability, unemployment, and a lack of growth. And I think that's where the fracture point could occur. At the moment, a lot of the countries, Portugal, Greece, Spain, up until recently, they were military dictatorships. That's why they like the euro. And I think they fear coming out of the euro, going back to the drachma, the peseta, and the escudo, could possibly, be a catalyst to go back to that.
Right.
But, and this is something that the eurozone need to deal with, and they're not dealing with it because of nationalist concerns. You've got the German election and what have you. Mrs. Merkel needs to be honest with the German taxpayer. They are going to be on the hook. They're going to have to write down Greek debt, Portuguese debt, and there's going to be write-offs in Spain.
There will be write-offs in Spain?
Yeah.
Okay.
You look at the property boom in Spain. How much bad debt are Spanish banks sitting on from houses that they've built that they can't occupy? Spanish unemployment, 25%, 26%. Youth unemployment, above 50%. That's only going to get worse while the economy contracts. If that gets worse, bad loans will increase. We've already seen data out over the past 2 weeks that bad loans are still increasing, even allowing for the fact that they have a bailout fund. So the problem's not going to improve. They're making cuts in all the wrong places. They need to stimulate the private sector. They're cutting in the private sector. They're raising taxes. It's the wrong approach.
Going too far on austerity.
Going too far on austerity in all the wrong places. They need to cut the public sector down and promote growth in the private sector. But what they've done is they've raised VAT. Well, that's a consumption tax.
Right.
So that's not going to raise anywhere near as much revenue as you think it does. Until you deal with the broken banking system within Europe, there will be no change. Europe will continue to stagnate for the next 5 or 10 years.
Do you think that is a viable solution, or do you think that's...
No. Social cohesion is at risk. You're seeing it in Greece. You are also seeing it in Spain, and you're definitely seeing it in Portugal. Debt to GDP over 100% is unsustainable. The IMF has said that. And the IMF are as culpable as everyone else. They bought into this, some of this discredited debt sustainability analysis. We were told that there would be no second bailout for Greece. Anyone with an abacus could have told you that there would be, and there was. And now the likelihood is there's probably going to be a third one.
Okay. In the case of Italy and France, two far bigger economies. Italy has its problems. France just got downgraded. It's a very solid economy, but even so, there are tensions.
There are massive tensions. I mean, Francois Hollande, when he came to power, said no more austerity and then puts taxes up to 75%. That's not a policy. If you're talking about more Europe, you have to sell that to your population. Unfortunately, the French have never been good at what I would call being collaborative. They're very self-absorbed in terms of what's best for them. You can talk about the EU-US trade talks as an example. They wanted their film industry exempted. They're very protectionist when it comes to their own self-interest. You know, the wine industry is another one that, you know, they're very protective of. So if you want Europe to succeed, then you have to let go of those sorts of things. And Francois Hollande has shown no evidence that he's prepared to do that. He's talked about it, but talking about it is one thing. And I think the only reason that French bond yields haven't risen as much as, say, Italy or Spain's is because they're last in line. But more than anything else, it needs to be they either need to, you know, join more together, or they need to think about what their policy is going forward.
Going their own ways?
Yeah, it's a possibility. You know, you wouldn't want to speak it out loud, but the current situation is not sustainable. At the moment, they're trying to go for more Europe, you know, and I use an analogy for you. There's a firecracker in my palm. If it explodes, no problem. But if you try and hold Europe together and you keep that firecracker in your palm, it'll blow your fingers off. And that's essentially what's happening at the moment, I feel, that there's too much focus on austerity. They've been talking about growth for the past 2 years. There hasn't been any. They're talking about a jobs programme, and they're allocating 6 billion or 8 billion euros towards the problem when you've got record unemployment. Well, that's nowhere near enough.
May I ask you, I'm not sure if I'm asking too much, to give viewers an order of magnitude of more or less. I know it's near impossible, if not impossible.
It's very subjective.
But an order of magnitude of just how bad of a crisis could yet occur in the eurozone?
Well, if you
to be realistic,
you know, if social cohesion breaks down, then really what's happening is you're getting extreme views starting to come to the fore. You're seeing it in Greece. Now, at the moment, the Greeks have been very, very patient, I would say, given what they're having to deal with. Now, some would argue that a lot of it's their own making. I would disagree with that. You're asking the politicians who created the problem to fix the problem. So there's still an awful lot of self-interest there. And it's the same in Spain, and it's the same in Italy, and it's the same in Portugal.
It looks like we have a less than all clear signal, perhaps, looking up.
We're going to have basically, what we're going to have, I think, is tensions, social tensions bubbling up. When it becomes clear that these countries aren't going to meet their targets and there's more austerity, you're going to have more protests. Well, you can only do that for so long before you can't do it anymore. And then Germany has to decide whether or not it wants to pay for the whole shebang.
So there is still very much a risk or risks for Mr. Carney to watch out for.
Yes, there is. But I wouldn't want to put a time frame on it, because it's what Mr. Draghi's done is he's taken the fragmentation risk off the table in the short to medium term. But it's such a, you know, it's such a maelstrom of different moving parts that it's hard to say where the next pressure point will come. It could be France, it could be the Netherlands, it could be Italy, it could be Greece, it could be Portugal. It's hard to say.
Okay. Well, unfortunately, that's all the time that we have for today. Mr. Michael Hewson, Senior Market Analyst at CMC Markets UK, thank you very much for your time and for being so frank.
No problem at all, thank you.
And thank you to all of us for joining us once again at Digital Look TV. And that is all for today from London. Goodbye.